Hi, everybody. Welcome to the Patty Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Today's podcast is part of the series called Ask Patty Brennan. We have a lot of people who ask us questions about 529 plans. And what I'd like to focus on are the mistakes people make with 529 plans. Really expensive mistakes, by the way. This stuff is simple, but it is not easy, and what you don't know can definitely hurt you. So, first and foremost, let's talk about 529 plans are state-sponsored. Depending on where you live, you can set up a 529 plan. Some states give you a tax deduction for your contributions. Many states have limits. Pennsylvania, for example, has a limit that is based on the annual gift tax exclusion. So husband and wife want to make a contribution, $17,000 per person. They get a nice tax deduction on their Pennsylvania income tax return. That is wonderful. I wouldn't let the tax tail wag the dog in this case, except that a 529 plan grows completely tax-free as long as it's used for qualified education expenses. Those expenses are up to $10,000 for high school, or undergrad, I should say, and then it can be used for tuition, room, and board for college expenses. So now let's talk about how they work. Here's the thing. Let's go through an example of a family that has 3 kids. A lot of times, young families, they're really motivated. They plow a ton of money into a 529 for the first child with the knowledge and understanding that they can, in fact, allocate some of that money in the first plan for the other 2 kids. Here's the thing. Yes, you can allocate that money for the other 2. However, it's not one big pot. Let's say that you've got $100,000 in the oldest 529 plan, $10,000 in the second, $5,000 in the third. Fine, you can earmark that money, but it must be transferred to the second beneficiary's account. You can't just take it out of that first account and send it. Let's say this is John, Sandy, and Samantha. I don't know. John, let's say that John didn't use all of his money. Mom and Dad hear this loud and clear. You cannot have John's money used for Sandy's education. You must transfer the money, any excess, into Sandy's 529 account first. Then you can send it or use it for Sandy's education. Same thing with Samantha's account. So that's first and foremost, fundamental. That is really important because a lot of people are really motivated to pay for education, and sometimes there's actually money that's left over. Oh, before I go into that, you can, in fact, reimburse yourselves. Let's say that things are running late and you forgot to call wherever you're housing your 529 plan to send it to the education and tuition is due. So you can pay it yourself and reimburse yourself, but it has to be to the penny. And be really careful, because I know I have 4 kids and, they were in the dorms for the first year or 2 and then they got apartments. The amount of the 529 plan that can be used to pay for that rent, it's limited to the amount that the university charges for the dorm. So no luxury apartments for those kids. You can't take that money out of the 529. It can be used for computers, books, things of that nature. So, again, fast forward, you've got the 3 kids, and John did really well. He may have gotten a scholarship, and he's graduating, and he's got money left over in his 529 plan. And guess what? We have this new law. Money left over in a 529 plan can be rolled into a Roth account for that child. First and foremost, number 1, John's 529 can only go into a Roth account for John as the owner. It can't go into Sandy's. That's important. Remember, just think of that segregated money for that child. That's really important. There are certain rules you got to keep in mind when it comes to doing these Roth rollovers, which, by the way, are a home run for those kids. What a great way to start life, with a funded Roth IRA that's going to grow tax-free for their lives. And by the way, they can use it for first home buyers. They can use it as a down payment on a house. There's lots of really cool things that can be done. I just want to go through the rules. Rule number 1, that 529 plan, in order for it to be eligible for that Roth rollover, had to be in place for 15 years. So mom and dad had to be planners and set up the account. Fund it with $1,000. Start the clock. That's first and foremost. Secondly, the money that you want to have transferred into the Roth IRA had to have been in there for a period of 5 years. So just remember, 15 on the account, 5 for the money. The most you can roll over into a Roth IRA for that child is $35,000. Now, let's say that John graduated from college, really motivated kid, took finance courses in college, and he understands the value of contributing to a Roth IRA. Here's the deal. If he wants to do that Roth IRA, which is a great idea, by the way, for John, the amount that you can put in and roll over from the 529 is reduced by the contribution amount that John's going to make into his own Roth IRA. So here's the deal. You don't have to do it all at once, okay? So let's say that there's money left over. He wants to do a Roth IRA contribution. You want to encourage that kind of savings. It's awesome. That's honestly more important than anything is for him to develop that habit. So here's the thing. You reduce the amount that goes into the rollover. Understanding that the limit is $35,000, just do it over 2 years instead of 1. Okay? You'll still get the $35,000 into the Roth. Just be aware there are limits. And by the way, you might say, well, Patty, how in the world is the IRS ever going to know? It does. Here's the thing. I'm just here to tell you what the rules are. The IRS is getting really smart. There's a 1099-Q, for example, that is issued for anybody that has a 529 plan. If you take money out of it, 1099-Q is coming out to you and, by the way, the IRS. In addition to that, under these rules, the universities are now required to send out Form 1098-T that reflects tuition payment. So in that example, that family, let's say, mom pulled out $90,000 from John's 529 plan and kind of used it for Sandy. Well, then the 1098-Q comes out and it says, well, John's tuition was $30,000. The IRS is going to say, wait a minute, there's a disconnect here. It lacks congruence. It doesn't match. And it might be a red flag that might cause an audit. And then you're going to have to prove that the money that was taken out of John's 529 plan was really for John. If you can't prove that, what happens? You owe taxes on the amount that wasn't used for John, and there's a 10% excise penalty. So, guys, this is kind of important. You don't want to pay taxes. You took the time to save the money in the first place. It's a pain in the neck. I totally get it. It's ridiculous. It's a paperwork thing to take the money out of John's account and put it into Sandy's account and Samantha's account. It's an administrative burden that is imposed on us by the IRS. It is what it is. Understand it. We don't like it. Do it anyway, so that you get this wonderful benefit that the 529 plan provides. I am Patty Brennan. That's just a little bit about 529 plans. We can go into the different states and the advantages and pros and cons of different states because there is a very big difference between the states. But we won't get into those weeds today. I just wanted to hit the highlights. Thank you so much for joining me today. I hope you have a fantastic day. We are Key Financial Wealth Management with wisdom and care. Take care now.